Good evening, everyone. It's a pleasure to welcome you all to today's webinar on Gateway to Global Investing, a strategic access through GIFT City. As global financial landscape continues to evolve, Indian investors are increasingly seeking avenues to diversify their portfolios and to tap into international markets, where GIFT City has emerged as a pivotal platform in this endeavor, offering a seamless bridge between domestic savings and global investment opportunities. For exploring more on this, today we have with us Mr. Alok Kumar, Head of Alternates Products and Special Mandates from Aditya Birla Sunlife AMC. Mr. Alok is a seasoned investment professional with over 16 years of experience in capital markets, investment advisory, and product development. Before joining Aditya Birla Sunlife AMC, he has led alternate and structured products and investment process at DBS Bank India. He has also played a key role in establishing India's first dedicated retirement solution firm under Principal Financial Group. During his tenure at National Stock Exchange, his contribution include developing the India Venture Board for VCPE deals and launching the SME Exchange. He holds an MBA from NMIMS Mumbai and BE in Electrical Engineering. Welcome, sir.
Thank you. Next
we have Mr. Ruddy Gopalakrishnan, Fund Manager at Liptus Capital Global Fund. Mr. Ruddy graduated with distinction in economics from Duke University in 2002, and he worked at McKinsey & Company until 2005. Then he earned his MBA from Harvard Business School in 2007. That same year, he joined Fidelity Investments, covering sectors such as oil and gas, utilities, and financials. In 2014, he began working closely with Samisim Nagar, portfolio manager of the Fidelity International Capital Appreciation Fund, and was later named as deputy after delivering strong investment results using a consistent and disciplined approach. Welcome, sir.
Thank you.
With GIFT City being India's global financial powerhouse, a flagship initiative from Government of India aimed at positioning the country as a leading player in the global financial markets, how has the GIFT City evolved into an international financial services hub, sir, over the past few years, and where its growth headed? Alok, sir, what are the offerings available from Aditya Birla Sunlife AMC through GIFT City, and what are the investment routes available to the investors? Can you throw some light on that, and who all can invest in those products, and what are the benefits available to them?
Sure, Arvind. Thank you for giving me a chance to on this platform. Good evening to everyone. I'm Alok. I take care of alternate products for both for domestic and offshore business for Birla Sunlife AMC. Today we are going to discuss about our gift offering. So gift, obviously, the first name when it comes, everybody thinks, what is this? So let me I have a small presentation. Just let me share with you. Is currently India's first and only approved IFSC. IFSC is International Finance Service Center. It is spread across 2,000 acres land near Ahmedabad in Gandhinagar. It's a free trade zone with various tax incentives provided to various financial services companies to enable flow of financial products and services across borders. The CT or IFSC is a globally benchmarked IFSC developed by Government of Gujarat through a joint venture with central government. This is a separate financial jurisdiction within India, even though physically it's in India, but it is considered to be offshore geography. It has been provided a sovereign support, including a special carve-outs from domestic laws. So the laws are different for them. The regulation is different from the domestic regulations. There is a single regulator, United Finances Regulator, which is IFSCA. Unlike there are 4 regulators for different finance functions within India, like RBI, SEBI, IRDI, PFRDA. So there is a single regulator. They have taken all globally aligned regulations. There is a light regulatory right touch regime. There is a fully fledged financial ecosystem which is already being created, and further improvements are being done with global connects. And the entire unit is treated as non-resident with various kind of tax incentives provided. When it comes to Aditya Birla Sunlife AMC, we were one of the first AMC to get a non-retail fund management entity license in November 2022 in GIFT City and to carry out restricted schemes under AIF and PMS. We already have done few funds from there. Currently, we are raising funds through our three of our funds. We have already done two funds where we have already completed the fundraising. The target investors for us is both resident individuals as well as non-individuals, as well as foreign investors and NRIs. We have created India dedicated funds for NRIs and foreign nationals. We have also created global investment opportunities for resident individuals, non-individuals, as well as foreign investors through GIFT. Obviously, when it comes to what are the benefits for them? So let's say, suppose if you are a foreign national or NRIs investing in India, the obvious advantage will be you will have lesser paperwork. You might not be requiring any NRE, NRO accounts. In Indian tax laws will not be applicable. There will not be any TDS. There will be no restriction on repatriation, and you can access some of the best of Birla or best of India mutual fund schemes. So these are the benefits which you will be getting when you are investing into inbound feeder funds, which is exclusive for NRIs and foreign investors. When it's offshore funds, these investors can also invest. The tax incentive will still be there in India. They will be taxed only in their own tax jurisdiction rather than getting taxed in India. But for resident individuals, this is the opportunity which will provide them to build long-term overseas portfolio. Currently, mutual fund route, as we are all aware, that is not available to create overseas exposure or dollar diversification. So this becomes the only route. Plus, suppose someone is having a dollar investing goals, dollar goals in mind. Let's say, suppose you have children education, some buying properties, or some starting a business, and all those things. In future, you can create portfolio even today by utilizing annual LRS limits, which is $250,000 per PAN per financial year, which you can remit outside. Once you have remitted through LRS, obviously you have to invest, and that's where we come into play. We help you in investing in suitable investment products. So we are providing you access to US dollar savings. We are providing global diversification opportunities by bringing best best global fund managers to you. Sitting in India, you might not be having access to these global fund managers, but Birla, being an Indian entity, is bridging that gap to you. Plus, when I'm talking of global diversification, you are avoiding home bias, because currently, when we see the statistics, only 1% of Indian savings is into international equities. So this could be additional opportunity for you, diversification and all. Plus, we are also helping you invest in companies or themes or sectors whose comparables or the trends which are not available in India. These companies or these trends are not available currently in India. So this is going to help in your investment journey or wealth creation journey also. Now, when it comes to our solutions, obviously we have inbound solutions where we are feeding into best of Birla or best of India mutual fund schemes. We are also investing into direct equities through our ESG funds. Then for outbound solutions, we have done in the past global structured solutions. We have created funds for investing into global emerging market equity fund, which we have closed just recently. Our current offering is to invest into global blue chip companies, which are some of the best companies available in the market, with the themes or trends which are not available in India currently. And that's where we are going to introduce Liptus Capital, where our fund, ABSL Global Blue Chip Equity Fund, is investing 100% into Liptus Capital Fund, which is going to ultimately manage the underlying portfolios. The structure is simple. We have a GIFT City wrapper, which is ABSL Global Blue Chip Equity Fund, which is going to invest into a global fund, which is Liptus Capital. ABSL AMC is the investment manager. Of overseas investors from offshore, like NRIs and foreign investors, can participate. domestic investors like resident individuals and non-individuals can participate. And so now I'm leaving it to our fund is 100% feeder into Liptus Capital. So now I'm handing over to Rudy, who is going to explain us the detailed product offerings, the fund positioning, and how he's managing the global investing aspects. So Rudy, over to you.
Thank you very much, Alok. I appreciate it. So if we just move on to the next slide, I think we just like to cover, how we think about investing globally. So the first question that comes to mind is what return should an investor expect over any medium-term perspective? What we show on this slide on the left-hand side chart is that over any 10, 20, or 30-year rolling period, total global returns in US dollars have been anywhere between 8 to 10%. If you look at the last 1 year, 3 year, 6 year, it shows very, very similar returns of around 8%. So conservatively, I believe one should expect an 8% return. The second thing I would say on the right-hand side chart is that rupee depreciation is something that needs to be factored in when doing an apples to apples comparison in India. So if you talk an 8% index return, you add approximately 4% for rupee depreciation, and you get a 12% index return. Now, there's a lot of thought on whether this 8% can sustain going forward, whether the 4% depreciation will continue going forward. But I think while there are many uncertainties out there, I think that these trends will continue, and we can talk a little bit about why. So if you think about an 8% index return, a 4% uh, depreciation, a 12% rupee return, our aspiration by buying the best 30 companies in the world is to outperform the index by 3%. So add on top of the 12%, the 3%, you get a 15% rupee compounding, which implies a doubling of capital every 5 years. Now, if you think about this, very infrequently does this happen in India. So if you look at the last 30 years, over any 5 year rolling basis, Indian stocks have given you that 15% return only 15% of the time. So the last 5 years have been very, very good, but this is not something that historically is sustained. So that's why I think having global diversification makes sense. Moving to this next slide, what we try and show here is that over the very long term, global stocks outperform almost any other global index. And on the right-hand side chart, does it the most consistently over any 5 year rolling period. So the key point we want to leave you here with is the two best stock markets in the world have been India and the US, and global stocks led by the US. Just buying these two offers very good diversification. And I would just keep in mind for those who've been in the market for just the last 5 years or so, Indian stock market returns, if you look at over the last 30 years, it's been comparable to global stocks. So after all the sweat and toil, India's GDP has increased 14-fold over the last 30 years. Global GDP has grown only 3.5-fold. So despite growing GDP 4 times as fast year after year than global stocks, Indian stocks have returned you an 8% dollar return, similar to global stocks. And this may sound quite surprising to people, but the reality is that GDP does not drive stock market growth. Corporate earnings per share does. So that's the big insight that if you have industries in the West that are well consolidated, they're set up to have high levels of profitability versus companies in India that are going through a more competitive process, and hence that's been the case. Also, I'd like to remind viewers that over the last 30 years, you've had two 10-year periods when Indian stocks give you a 0% return. The big return was made in two 5 year periods, one between '02 and '07, and one post-COVID in the last 5 years. Most investors tend to extrapolate this return, but that's historically been a mistake. So adding global diversification helps. Moving over to the next page, we set the context in terms of what you can expect in terms of returns. If we move to the next page, Alok, what we will find is that over long periods of time, technology has really been what has driven global stocks. So a lot of people think technology is in a bubble, but if you look at the last 10 years, the total return from US tech stocks has been 18%. But the light blue line, which is below that, shows that 14% of that 18% has actually been earnings growth. So have you had a re-rating of 4% a year? Yes, you have. Has that been beneficial to total returns? Yes, it has. But it's been driven primarily by earnings. And if you look at the bottom two lines, what this shows is X-Tech, The total return has been 9% over the last 10 years, and the earnings has been 7%. So while you have had some re-rating, ultimately earnings is what drives stock price performance. And hence, we believe technology will continue to lie at the heart of strong risk-adjusted returns going forward. Moving to the next slide, what this chart shows you is over the last 25 years, there's been one mega trend after the other in tech. You had the PC growth, you had the mobile growth, you had data, and then you have the digitization of everything taking fold. Looking forward to the next decade, we think themes like artificial intelligence, virtual reality, mobile data center, and high performance computing is something that will drive the next 10 years of growth. And we're already seeing early signs of that. Given no Indian companies exposed to these mega trends, we're exposed to companies that benefit from cash flows arising from these trends. So this is something that your fund will have in their 30 stock portfolio. Moving to the next slide, what we try and show here is just a little bit of background about us. So just to start with myself, I think the introduction was already made. I spent almost 16 years at Fidelity. The assets we managed was around 15 billion. Prior to that, I did my MBA from the Harvard Business School. Prior to that, I worked at McKinsey for 3 years. And prior to that, I did my undergraduation at Duke University in the US. Why did I decide to start Liptus Capital along with my team? We just felt that owning 30 blue chip companies globally with an emphasis in the US is the way to beat the market over long periods of time. The team comes with decades of combined investment experience at Fidelity. If I was to briefly describe them on the next page, a couple of my colleagues, we've had almost 17 years of overlap, as shown in the next page. And basically, what we try to show on slide 14, Alok, is that the two teams, our members are on page 14, are Himanshu and Rahul Gupta. We all have overlapped at Fidelity for many decades. Rahul covers the technology sector, Himanshu covers the consumer and healthcare sector. And basically, what we do is our investment universe is 80 companies, which we've analyzed for the last 20 years. That's our raw material. What we try and do is divide these 80 companies between us, and each of us have 25 stocks that we cover, and we're just trying to find the best of the best. So that's the way we kind of tend to think about investing, that with years of experience, having gotten trained at Fidelity, we feel we have the ability to stock pick. Moving to the next page on slide 15, what we just try and show here is an emphasis of what we said. We'll buy the highest quality growth companies. Our active share will be at least 70%. So we're significantly differentiated versus the benchmark. And what we really aspire to do is beat the benchmark on any 5-year rolling return basis and create outperformance. And that's the 3% I was talking about earlier in the call. Moving to the next page, what we try and show here is on page 17 is on page 16, sorry, what we're trying to show here is just how our process works. So basically all our businesses have attributes that have one or more of these characteristics. They're best in class, barriers to entry, and brands. So ultimately, if businesses have these characteristics, we believe they're very good indicator of future outperformance. Now, if you look at the portfolio, everybody aspires to have these kinds of attributes, but ultimately, quantitatively, where is this reflected? We believe that our businesses typically at the portfolio level have a 20% free cash flow margin, a 20% return on invested capital, and have the ability to grow 10% a year in US dollar terms. Now, these are very, very attractive metrics. If you can find companies trading at reasonable valuations, offering you these metrics at the portfolio level, we think that's very, very attractive. So just to give you some context, earlier in the call, we talked about an 8% index growth. And if you decompose that, 5% is earnings per share growth, 3% is dividend yield. So if you think about the index growing 5% versus our 10% aspiration, that's almost twice as fast as the index. So I think we set the bar very high in the Indian context. If you ask yourself, how many Indian businesses generate a 20% free cash flow margin and a 20% in return on invested capital, very few companies in India do. Some of them will be the IT services companies and the consumer goods companies. But then when you marry the 10% annualized earnings per share growth in dollar terms on any 3-year rolling basis, it gets whittled down to even fewer. So basically, we're trying to buy the best of the best. We say just buy the 30 best blue chip companies and go home. That's a great way to diversify. Moving to the next page, what we try and show here on page 17 is how the portfolio construction is done. So we'll own 30 names. We'll have 70% active share. Each country or sector will be plus or minus 15% of the index. What we're trying to do here is be a fully globally diversified fund. We're not trying to become a US tech fund or a European industrial fund or a Chinese consumer fund. We're just trying to find large cap growth companies, have position sizes of around 3% over the active weight. And basically, so if the index weight is 3%, we'll own 3 plus 3%. So that's 6% if we like the name. If the index weight is 3%, we don't like it, we own zero. And if the index weight is 0% and we like it, we own 3%, it's 3% of the portfolio. So that's how we think about position sizing. We have all our stocks are like 3% overweight and they float plus or minus 100 basis points. Moving to the next slide, what we try and show here is how dominant our companies are. So just to give you an understanding of how dominant these companies are, these are like our top 9 or 10 holdings. And what we show here is that our businesses have anywhere between a 40% market share for Amazon to almost a 97% market share for ASML. So what this means is that whenever you have some kind of economic turbulence, whether it's inflation, whether it's tariffs, ultimately the mark of any great business is the ability to have pricing power and the ability to pass that higher prices down onto consumers. We believe our businesses, and these are just the top 10, we can go through the other 20, but our businesses possess pricing power. They're less susceptible to demand shocks and basically have the ability to keep compounding shareholder returns. Now, this market share has kind of held steady for the last 3, 5, 10, 20 years. Will this hold true going forward too? Remains to be seen. Our belief is that at the margin, some of these moats may go down, but we don't think all of the moats go down at the same time. So that's how we think about stock picking: is back businesses and management teams that have many, many decades of outperformance and that have the ability to withstand all kinds of economic shocks, whether the recessions, whether it's tariffs, whether it's inflation. Moving on to the next slide. On slide 19, one of the things we look for very closely in businesses we own are the relative market share gains strong, and is the market share stability there historically? The reason why we say this is we're not looking for stocks that can go from 5% market share to 30% market share, because ultimately that 30 could fall back to 5 if a bunch of things happen. What we're looking for is companies that have a relatively high market share relative to the competition and the ability to keep growing that market share. And relative market share between competitors are pretty stable, which means that you've really created a monopoly or a duopoly in your particular industry structure. Ultimately, the businesses we own have one of three sources of competitive advantage. Either they exhibit some kind of customer captivity, either they have economies of scale, or there's some production cost advantages that allow them to earn a return on invested capital significantly greater than their cost of capital. So we believe that, over 2 decades at Fidelity, we've picked 80 companies that are unbelievable, that have very strong moats. Of those 80, based on valuation metrics, we choose 30. And do some stocks go in and out of the 30 stock call list that we own? Yes, they do. Do some stocks go out of the 80 stock list? Because obviously facts change, regulatory environment evolves, competitive situation also changes from time to time. So we do make changes, but at the margin, we think we have the raw material to basically beat the market. Moving on to the next slide. What we try and show here is there's a feeling out there that we're in a bubble. But what we show is, big tech outside of Tesla, we don't think is really in a bubble. So what we show here is on any 2-month rolling basis on the left-hand side chart, what has been the total return versus the global index. And what we find is the green bars are when on a 2-month rolling basis you outperform, the red bars are when you underperform. And what this chart shows is, the current 18% underperformance of the MAG 7 is not something that's never happened before. It has happened before. But as you'll see in this chart, it happens very infrequently. And conversely, the green bars happen much more frequently and the bars are much higher, which means that in times like this, it's time to hold your nerve, not get scared, and own these companies. So the reason why I say this is in the middle chart. This shows that, despite capex going up from almost $50 billion to $250 billion, the free cash flow has gone up even faster, which is quite unbelievable because typically capex reduces the amount of free cash available to shareholders. But the reality is that the cash flow from operations has just gone through the roof. So companies like Google, companies like Meta are already using AI to better target advertisements, and that's yielding phenomenal results and higher margins. So these companies are very, very unique in that respect. And what I would say on the right-hand side chart is that over any 5-year rolling basis, over the last 10 years, you've seen that the Fab 5, which is basically what we own, which is ex-Tesla, ex Apple, which we don't own. So we call them the Fab Five. Are they going to slow down versus the historical furious rates of growth? Yes, they are. But are they over the next 3 years going to compound almost twice as fast as the index? Despite that, we think so, and that's a good place to kind of make money. Moving to slide 21, what we show here is marry fundamentals with valuations. You can see from this chart that the Fab Five, which is the Mag 7 minus Tesla minus Apple, which we don't own, trades at only a 20% premium versus the market, which we think is extremely attractive. It's never been at these levels in the last 10 years. And if you look at the right-hand side chart, the absolute EV/EBITDA is only 14 times. So if you think about 14 times for the best five companies in the world in the field of technology, we think it's very attractive. Moving to the next slide, on page 22, we just show you that over long periods of time, we've been significantly higher EPS growth versus the market. Remember, we aspire for at least 10%. If we get higher, we take it. And if you look at the free cash flow margin, the ROIC, they're just phenomenal versus the index. And that's why we believe this combination of having faster growing companies with higher ROICs and higher free cash flow margins is a recipe for our performance. Moving on to the next slide, what we show here is that how does this compare versus the globe? So what you see on the left-hand side chart is that the All Country World Index trades at a 16 times earnings for an EPS expected anticipated EPS growth of 10%. But if you look at India, it trades on a 20 times earnings with lesser EPS growth of 6% in dollar terms. And of course, if you look at IFA, which is Europe and Japan, it's cheaper. It trades on 13 times, 14 times earnings, but with much lower EPS growth. So what we find is globe versus India looks very attractive now. And on the right-hand side chart, what we show is that while long-term average P for the index, the All Country World Index, is 16 times exactly where we are in line with the long-term average, we always look at our portfolio and see relative to the index, how do we compare? And here too, relative to history, we're trading at reasonable valuations in line with history. So the way to read this chart is when you buy such a high quality business with such high corporate governance led by the best management teams in the world, you will always trade at a premium versus the index, but not at twice the valuation, right? So that's ultimately what we look for is if you have twice the EPS growth, twice the free cash flow margin, twice the ROIC, if you trade at twice the valuation, then what value are you getting? But if you trade only at a 50% premium, then you're getting your money's worth. Moving on to the next slide, on slide 24, we just show you this is our entire portfolio all put together in one place. As you can see, in brackets are the percentage of the portfolio held in those companies. And you can see from this chart that these are basically the best of the best. They have dominant market shares, very good management teams, and they have the wind to their back. So all of these companies you will see have some technology element embedded in them. So while you have industrial companies, they all have dominant market shares or have some tech angle. If you look at the consumer companies, again, they all have a tech angle. Similarly, with financial services, for every card you swipe, every time you swipe your card, Visa makes money. Every time you issue a rating, S&P Global makes money. Every time you issue a corporate insurance policy, Arthur Gallagher makes money. So similarly, for all these businesses, they're very capital light. We don't use leverage to kind of generate these high returns. And we think these are the bluest of the blue chips out there. And if an Indian's looking to diversify, you want to just diversify into the best companies globally, diversified across countries, across sectors. Moving to the next slide. What we show here is our overall portfolio on the left-hand side chart. Remember, we went through the dominant market share of all these businesses before. And on the right-hand side chart, we show you the wagon wheel of where we've invested our capital. One thing to note about this is you'll see the US is 73% of the index of the total exposure. But ultimately, what we do is we don't think we're heavily exposed to the US per se. Likewise, you'll see on the wagon wheel, a lot of these countries like France, Taiwan, Canada show up. But really, these are global companies, right? So if I was to give you an example, in France, we own LVMH. They're a French-based company. 8% of their revenues comes from France. So is LVMH truly a French company? We don't think so. It's a global company. Similarly, with Taiwan, the bulk of their revenues comes from outside of Taiwan. They're hardly a Taiwanese company. Similarly, with the Netherlands, ASML is a Dutch EUV lithography manufacturer. 0.4% of the revenues comes from Netherlands. Are they really a Dutch company? Likewise, if you move to the next slide, what we show you is that while the US is 73% or 74% of our portfolio and 64% of the index weight, in terms of our portfolio revenues coming from the US is only 51%. So what we're trying to show you here is all these US companies are multinationals, they're fully diversified. So just when we look at country exposure, we look at underlying revenue exposure. Moving to the next slide, we show you the sector wagon wheel on slide 28. Again, very well diversified across sectors and countries. And the right-hand side chart shows you what percentage overweight or underweight were these different sectors. And you can see from this wagon wheel that we do have sector and country guardrails to ensure we consistently compound. But we do like consumer discretionary, industrials, and IT over financial staples and healthcare. But there are a whole tail of sectors like energy, utilities, and real estate, which we just don't own. Moving to the next page on slide 29, this just shows you that um, we started these discussions around 18 months ago. So we ran this portfolio till then, and since then we've gone live last month. And what we just try and show you here is that the fund is off to a good start. You'll see that over long periods of time, our aspiration is to beat the market by 300 basis points a year. You will see that the last 6 months have been a little bit choppy, but you know typically what we find is, and I've been saying this repeatedly to everyone who would listen, is that just in the last 2 weeks alone, you've gotten back whatever seemingly you lost in the last 6 months, which is quite incredible. But fortune favors the brave. I think I was hell bent on telling people that this is a good time to invest, and I still continue to believe this is a good time to invest, because if you're getting things that are cross cycle averages, and you're getting great companies at these valuations, can you fall 10-15% if there's a sentiment change? Of course you can. This is an equity market, nothing is guaranteed. But over long periods of time, the aspiration remains to beat the market by 3% a year. So moving to the next slide, I think what we do here in the next set of slides is just show you examples of the companies we own. In the interest of time, I'm going to pause here because we had allocated around 30 minutes for Q&A. But I would advise you to just look at some of the stock examples to bring to life some of the companies we own, the valuations they trade at, and answer any questions you may have. So I'm going to hand this now back to Arvind for him to moderate a discussion and to answer any questions people may have. Thank you for the time.
Thank you, sir. Thank you, sir. It was an insightful presentation, sir. And we have few questions to ask you, sir. Given the 70% allocation to the US in this fund, what makes the US market particularly compelling to you, sir? And do you anticipate diversifying further into Europe or Asia going forward?
So, a lot of these questions I'm seeing in the chat are related to this. So I think
Yes.
it makes sense to kind of talk about this. I would say that I would say three things, right? If you step back and say, where should I invest in the world? The way I would think about it is as follows. The first thing I would do is I would say, look at history, because history teaches us a lot of lessons. In the last 30 years, the two best performing markets have been global, led by the US and India. Right? Now you have to ask yourself, China's grown their GDP 30 times in the last 30 years. But despite that, total stock market returns from China has been zero. Right? Europe was a very rich country. Over the last 30 years, it's become a museum. Right? Japan, very rich country. Over the last 30 years, it's more resembling a hospital. Large tracts of Latin America have high rates of inflation, uh, but they resemble banana republics with all the kinds of issues they have. Because just think about it, if you grow your earnings in local currency 10% a year, which is very good, and your currency depreciates 10% a year, in dollar terms, you've had zero growth and zero returns. So large tracts of Latin America are like that. And then you have countries like Russia and South Africa, which again, they're just the rule of law and things like that are just out of control. So I think there's a reason why the US, global led by the US and India have been the two best performing markets historically. And I think these two will remain the best two performing markets. And any skepticism needs to be seen within this context. Point number one is rule of law. Like these two countries have a rule of law. The government can't just decide whatever they want. They can't tear up the constitution. And that gives some kind of support to institutional investors who invest in equities. This is something that we take for granted, but just go to all these other countries I mentioned, and you'll realize that this is an issue. The second I would say is actually quite counterintuitive, but both these countries, the US and India, have twin deficits. Now, twin deficit is supposed to be a bad thing. Why am I saying this is a good thing for equity markets? It's basically because the markets control you. So whether it's the equity market, whether it's the bond market, or whether it's the currency market, if you and the government make policies that investors don't like because you run a twin deficit, investors react with their feet. And that kind of is a disciplining mechanism on the governments and policymakers. This, to my mind, is why these two markets have done so well. So it's kind of counterintuitive, but in China, for example, you know, they have the ability to take short-term pain because they have a current account surplus, they manufacture and sell to the world. They can take short-term pain. They don't have that kind of pressure. If the market falls 30%, they couldn't care less. Likewise, if you look at large tracts of Europe, because they don't invest in technology, because they're not materially imbalanced, and because they have no innovation there, and they're okay with their with that weakness, right? Like politicians come in and out, in and out, in and out, nothing really happens. So they really couldn't care less. So I think if you look at the last 30 years, this has been the case. So I would continue to say the US, global led by the US, which is 65% of the benchmark, and India will continue to do well. Are there two caveats I would give you? Yes, they are, right? Which is A, it's been a bad idea for the better part of 250 years to bet against the US. So those who are calling the end of US exceptionalism, this, that, I think honestly need to study history, not just the last 3 years, 5 years, 10 years, 20 years, 30 years, because some people think this whole trend has happened just in the last 5, 10 years. But the US has been exceptional for the last 250 years. And betting against that is betting against history. And I wouldn't do that because nothing fundamentally has changed for me to alter my view. Also, something very important to keep in mind is why these US companies do so well is because they operate in consolidated industries. And if you can find businesses operating in monopolies and duopolies, that's how you make economic profit, and that's what drives stock returns, right? So I'll give you the example of the Indian telecom sector, where in the Indian telecom sector, for the better part of the last 10, 15 years, it was a terrible sector. There were 13 players, banks took a lot of debt write-offs, companies went bankrupt. But today, there are two and a half players there, right? Bharti is there, Reliance is there, and Idea is the half that's barely teetering on the brink of survival. To keep Idea alive, the government needs to pressure the big two guys to keep increasing tariffs, and all that money flows right through to the bottom line. And suddenly, this becomes very profitable. If India and other emerging markets and Europe had a lot of these monopolies, duopolies, the earnings per share would be much higher than what it is. So that, in a nutshell, is why I think that all this skepticism is really not warranted. Yes, what the US is not used to is business uncertainty. So every time Mr. Trump opens his mouth, it's not a good thing. And you have these short-term gyrations. But if you have your eye on the prize, which is earnings per share growth, and you look at history and you say, okay, listen, earnings per share growth have grown 5%, 3% from dividend yield, 8% return, rupee depreciates 4%, 12%, our long-term outperformance is 3% historically. And this assumes a fee of around 1.5%, just to answer that question that came up. So if your fee is a little bit higher, then you can increase or decrease that return. Again, if you're bullish or bearish on the currency, you can adjust that return. On the 8%, if you think the EPS and dividend yield will be different going forward, you can adjust those returns. I'm just trying to provide a framework as to how I think about it. So in terms of allocation, what we do is, even if, because of all the reasons I articulated on Europe, Japan, LATAM, if they're world-class businesses trading there, we do buy them, but I would have a heavy allocation to the US over Europe and EM. And if in EM and Europe you find some world-class businesses on a bottom-up stock picking basis that aren't exposed to Europe and EM, that are exposed to the wider world, I would buy it.
Okay. Okay. How do you manage currency risk in this fund, sir, especially with INR-based investor exposed to USD, Euro, and British pound fluctuations?
So basically, the way I think about it is I think about everything in US dollars. So I'll give you an example. Today, I don't have any investments in the global fund in India, but if I was to invest in India and someone says this company will give you a 15% EPS growth, I always think in my mind 11% dollar EPS growth. I always adjust that 4%. So every country, I have a framework that deducts what I think will be the currency depreciation every year. India is more stark. So if you look at countries like Brazil, that number is 9%. If you look at South Africa, the number is 7%. So these are large currency depreciations, but I always keep that into account. And when you get to the 5, 7, 8, 9% range, it doesn't make sense to invest anywhere, right? Because which companies are going to generate greater than those returns sustainably? So yeah, I think like a dollar-based investor. So every country I go to, I do make that currency adjustment because ultimately I earn in dollars, right? We hold things in dollars. Most of the stocks we own, even outside the US, are ADRs in the US. So I always make those adjustments.
Okay. Okay. With Nvidia and Microsoft are among your top holdings, what gives you conviction in this name, sir, despite rich valuations, sir?
See, this rich valuation is a myth, Arvind. So
Okay.
if I ask anyone on a call, I'm giving you two, three statistics. Statistic number one, in the last 5 years, how much is if Nvidia was at $100, hypothetically, right? Just as an index. In the last 5 years, what return has Nvidia given you? The answer is it's gone up 15 times in the last 5 years. One
Yes.
five. So 100 has become 1500. Now, if I gave you that statistic and I told you what price to earnings multiple is Nvidia trading on, and I told everyone in this group to guess what this is, people will give me a number that's actually far higher than what reality is. The reality is today, Nvidia trades on a 19 times forward earnings, right? So, Microsoft, you mentioned, Microsoft has the best long-term track record of any corporate anywhere globally. They have a 50% market share in office desktop software. They have a consistent track record of compounding, having an operating margin of 30% plus. They trade on 25 times forward multiple, which I don't think is egregious for that kind of a monopoly. You look at Meta trades on 20 times earnings. You look at Google, it trades on 16 times earnings. So these aren't expensive companies. Like it's a myth that these companies are expensive. Just to give you some context, Cisco at the peak traded on 120 times earnings. So people talk about bubble, people talk about all these different things, but all those who are skeptical about taking US centric exposure are probably reading the Times of India and looking at the news channels, but they're not looking at total stock market returns over the last 1 year, 3 years, 6 years, 10 years, 20 years, 30 years, right? People aren't looking at the data. Like I'll give you this example, right? The way to convince clients is just ask them if you went on holiday 1 year ago and someone told you don't be in the US markets for the next 1 year, be in emerging markets or be in these other markets because Trump's going to come to power. He's going to do what, in his opinion, is right for the US, and the US is going to derate. So don't own it. What would you do? You'd probably sell your global stocks and US stocks and buy all these emerging markets. But look at the last 1 year. Just the opposite has happened. The US has done much better. So I think people typically get worried. The US got a little bit of what I call a Trump bump when Trump came to power. That Trump bump evaporated because markets don't like uncertainty. And today you're trading it across cycle multiples of 16 times. Your growth expectation is what it is. So I would say that actually, if you get away from the noise and look at long-term history and long-term track record, and you see what valuations these companies are trading on, what their market share is, I don't think it takes a rocket scientist to figure out that these companies will do well.
Okay. Okay. With NVIDIA at the heart of AI boom and technological innovation, where do you think the company or the sector as a whole headed in the next few years, sir? Are there any surprising shifts you are closely watching in this AI boom?
So I think the AI boom has just started. We're just in the second innings of this, and when I say second innings, I'm not talking about cricket. I'm talking about baseball, which has 9 innings. So I would just say that just keep three things in mind. One is, you know, they have a 85% market share in GPUs, NVIDIA, and they've had this market share for a long period of time. Demand is exploding. I don't know who's going to win the AI race. I don't know who's going to win in the application layer, but I know that the guys who's providing the tools in order for AI to function is going to win. And that's NVIDIA with 85% market share. The second, there are two risks people talk about. So let's address those. The first risk is could NVIDIA's moat get disrupted by another competitor? Huawei, which is a Chinese company, has great technology, but so far we haven't yet found a technology that can rival NVIDIA. And remember, NVIDIA is becoming better and better every year. They're on a 1 year product cadence, which means every year they release a newer product. And a lot of people think about NVIDIA as being a chip, but it's not really a chip. It's a software company because it's the chip, it's the software, and it's the integrated wires that connects that makes them the lowest cost producer in the industry. So even if you were to give the chip away for free, you still wouldn't be able to compete with NVIDIA because everyone's on there using their software and becoming better and better. So could that moat change in the future? Maybe, but I don't think over the next 3 to 5 years I see that. And definitely not factoring in 19 times forward valuation. The second thing people talk about is DeepSeek and things like that when the stock had a little bit of a wobble. I would just point out that, there's this thing called the Jevons paradox, which if you look back many decades ago when coal efficient power plants came into being, a lot of commentators said this is the end of the coal industry because these power plants have become so efficient that no more coal will be required. But it turns out the demand for coal absolutely exploded because the use cases for coal efficient power plants completely exploded. Suddenly you had electricity in your home, you had it in the factory, you had it everywhere where you didn't think you needed it. So I think something similar will happen with data and AI, which is DeepSeek is a very neat engineering hack, but we think that the applications will just explode, and AI and the guys who are producing the chips will really benefit. So while I don't know who the winners in the app layer will be, so if you remember when the internet came, Google and Meta and all these guys won many years after the internet came into being. So it's very hard at this stage to predict who will win at the app layer, but at the infrastructure layer, it's much easier to predict.
Okay, okay. Your Liptus Capital Fund has higher exposure to information technology and consumer discretionary businesses, sir. Do you think these sectors have structural tailwinds, and how do you view these sectors going forward?
Yeah, so I think I wouldn't invest in them. So I remember I'm a bottom-up stock picker. These 30 names I think are going to grow really well in the next 3-5 years. Like this country industry classification I do look at, but ultimately, does the company have a dominant market share? Do they have the wind to their back? Are they going to grow really well? And are they trading at fair valuations? So this, based on bottom-up stock picking, leads to the top-down conclusions. But this is, and they may look like the economic in an economic recession, these companies will fare poorly given they're cyclical businesses. But what I think is relative to what they've done historically in drawdowns and in weaker economic environments, I think they hold their weight and they do well.
Okay, okay. Given the fund invests in dominant business models and high growth businesses, how do you ensure you enter at reasonable valuations, sir? Do you have any method for it? Like, because basically these dominant business models may trade at premium valuation. So how do you ensure, and do you have any method for it to, to enter a stock?
So what I do is, I jokingly say I don't buy a P greater than my age. So any stock that has a price to earnings ratio greater than my age, I don't buy. And I've kept a limit of 45 because I find that the older I get, the more mistakes I may make if I don't put that limit. But jokes apart, I think what we try and do is we think if you can buy world-class dominant businesses for 25 to say 30 times earnings, and you just compound, it's very, very good. So in the Indian context, again, given all of you are from India, I'll just give you context on this, which is if someone told you buy HDFC Bank, so sorry, sell HDFC Bank, Kotak Bank because they trade on 25 times earnings, and buy Indian Overseas Bank, REC, PFC, all these PSUs, banks, which is cheaper? These stocks, these Allahabad Bank, J&K Bank, all these banks at 8 times earnings, or HDFC Bank and Kotak at 25 times earnings. It turns out over the last 10, 20, 30 years, the 8 times P stocks were way more expensive, right? And the 25 P stocks were way cheaper. So what we do is we don't think like buy at any price makes sense. Like some people have this view that I just buy the best businesses and I don't care about valuation. Our investment time horizon is 3 to 5 years, right? We have to consistently compound over that period. Our holding period is not forever, like Mr. Warren Buffett. And one should be very careful that you put portfolio construction guardrails in place and valuation guardrails in place to make sure that your investment time horizon matches that with what you've promised to do and what the client expects. If you have a 1 quarter, 1 month, 1 year view, then this fund is not for you and you should not invest. But that's how I tend to think about it: is take the 3 to 5 year view and do it. In terms of how we've talked about lock-in period, the reason why we've kept a 4 year lock in the fund is we don't want clients to have a bad experience with us. If the client makes a mistake after 4 years and redeems, then it's our fault. But if the client redeems interim, it's their fault. But we don't want to give clients that opportunity. So we're almost self-selecting our clients to say that if you don't have a 4 year view, don't invest, don't make the mistake, invest in the market elsewhere.
Okay, okay. How do you able to generate significant alpha over benchmark, sir? Because the fund also has a higher free cash flow margins and return on invested capital comparison to the benchmark index. How do you able to identify those businesses?
So 20 years of hard work, sweat and toil to first identify these companies, learn from what these companies do well, learn where these companies don't do so well, understand cycles, and then be very valuation focused. So I would say just experience over the last 2 decades that have gotten us to get these companies. We have a detailed understanding of what we like, what we don't like, and just basically sticking to your knitting, right? There's a detailed investor guide. I see a lot of questions come up in the chat box. I don't know if we'll have time to answer all of them, but there's something called an investor guide that I've written. It's a 5 page note that basically tells you, is this fund for you or not for you? So a lot of the questions being asked can be covered, are covered in this. But yeah, I think that from time to time, there are many companies that also generate free cash flow that are also growing very well. Someone in the chat mentioned Spotify. So look, we like Spotify. It is generating free cash, but the market share and the relative market share versus its peers, like Apple Music and these other guys who are very, very cash rich, we just don't know whether the product's differentiated enough, right? So we set the bar very high. So if we set the bar at a level where we're absolutely convinced it's black and white, we do it and then we track like, hey, like these companies aren't bulletproof, right? Some of these companies are going to lose their dominance. So we just got to keep looking at that moat and say, is this moat expanding or is it falling?
Okay. In your unique QGB framework, you set a threshold of 18 to 20% free cash flow margin and return on invested capital, sir. How do you handle a situation when a company temporarily falls below that corridor, which you have set
Yeah, I'm
for
glad.
your portfolio companies?
Sure. So I'm glad you asked that question. That 20% is the average for the portfolio, right? So you'll always
Okay.
have some companies that are above or below. 20% is the average. We try and be significantly over that. But there's some businesses where if they're reinvesting at incrementally higher returns on invested capital, we're looking to look past that.
Okay. Okay. And how do you approach diversification in your portfolio, sir? Do you prioritize it at the country level, industry level, or else both?
Everything at the stock level, country level. So all our position sizing framework, 3% overweight, active weight, plus or minus 15% any country or sector, looking at the underlying revenues of the company. We're fully diversified across everything. So you need 10 stocks, 15 stocks to truly diversify. We have 30, so I don't believe diversification is an issue. I think all we want to do is just think about taking the 3 to 5 year view, having a 20 to 33% turnover, which equates to a 3 to 5 year investment time horizon. So you'll always find some turnover, because if you have 0% turnover, that means that there's something wrong, right? Because facts change, competitive environment evolves, things happen. So the way we tend to think about it is our companies aren't bulletproof, but the chances that we can buy and hold are far, far greater.
Okay. How are you positioning the fund for a soft landing or maybe a mild recession in US, sir?
So again, I think anyone who forecasts tells you more about the forecaster than the forecast. So I'm very skeptical about people who talk about recessions because there's a joke here in the US that economists are those who predicted 10 out of the last 2 recessions. So I can't tell you when the recession is going to happen if it's happened, but I can tell you that the portfolio is geared to be resilient. So whether you get recession, whether you don't get a recession, whether you get inflation, you don't get inflation, whether you get tariffs, you don't get tariffs. If you find the best companies in the world that are economically resilient to head bumps, uh, and they have pricing power, you land right side up. So we're always geared to that, right? So I think one set of questions are on the returns. I'll just quickly answer them. All the returns we have in the presentation are all USD. They're not INR. So we're US-based investors. We think about it that way.
Okay. Thank you, sir. Alok, sir, this question is to you. This product is a fixed fee product or it's a performance fee product, sir? If it is a performance fee product, what is the hurdle or high watermark principle which investor has to know?
Arvind, we have a model where we only keep fixed fee for all our feeder funds. So this fund also has only fixed fee. There is no performance fee. Rather, even at my end, even at the underlying fund Liptus Capital. So there is no performance fee here. Everything is fixed.
Okay. Okay. Alok, sir, if you're okay, we can move to audience questions, sir.
Yeah, sure.
Okay, sure. So Pratik is asking, do you see US outperformance continuing as liquidity will slow down in the US versus how it was in the last decade? So maybe he was asking about US market performance. Rudy, sir?
So I think Rudy has already explained what merits he sees in US market
US
and why he
liquidity.
sees. So I think so this question might have come before he did it because it has come at 4:47. So he has already explained.
So if it's okay with you, Arvind, what I'll do is I'll just quickly scan the questions and try my best to answer as many of them as possible, just in the interest of time because there are a lot of questions. So let me just try and answer stuff that has not been answered. So this is one question from Aman where he asked about the debt to GDP ratio, and whether that's going to be an issue. So look, I think if you see Warren Buffett 25 years ago was worrying about this, and it turns out that, and his worries were very valid 25 years ago and valid today too. I think the single biggest reason why people don't appreciate why higher debt to GDP is not causing high inflation and this is, sustainably over long periods of time is because technology is very, very deflationary. And this is something people don't appreciate as much. So if you look over a period of time, as automation has happened, as technology in the economy has grown, we've gotten more and more efficient, which means the velocity of money has really come down, which is why you haven't got inflation. Whereas in a country like India, that also prints to fund deficits, inflation has been 7% for long periods of time. So I would say that going forward, taking a 10-year view, AI, machine learning, all these things are going to be massively deflationary. So despite higher debt to GDP, I think interest rates are going to start to fall. And that's something that I won't worry too much about given this dynamic. Don't forget, Japan has like a 250% debt to GDP. Europe's even higher. Nothing's happened there. And that just goes to show you that when you have deflation, like the way you've gotten in Japan, not because of technological reasons, but because of demography, this is what happens. The taxation for NRIs and residents are different. Sudhir from our team can take you through this in great detail. I would just reach out to him at the end. His details are there in the presentation for taxation related questions. There's this question on robots taking over the industrial manufacturing space and questions on India and whether this will happen. So I think over a period of time, automation is here. I think this is very negative for jobs. For a country like India, it's particularly negative because we have this huge demographic dividend that could turn into a demographic nightmare. So I think Rohit's question is very valid. So I think what the Indian government needs to do is think very strategically on where we want to focus our energies. I don't think building the next China should be India's focus. I think developing consumer and service sector will be more important.
Alok, sir, one last question, sir. Mohammed is asking, does Aditya Birla have any Sharia compliant investment products?
No, currently we don't have in AIF and PMS platform. There are a few other questions regarding minimum investment, fees, taxation, and all. Okay. So the minimum investment being an AIF, it's $150,100. The fee for the base share class, which is between $150,000 to $250,000, that is 1.5%, going down for a higher ticket size to 1.25 and 1%. In terms of taxation for resident Indians, the taxation rate will be as long-term capital gains, whichever is applicable in India, which is currently 12.5% post 2 years. Then for foreign investors or NRIs, the taxation is as per the tax residency status of those investors. There is no taxation in India. We have separate share classes catering to NRI and foreign investors, separate share class, and for domestic investors, resident Indians and individuals, separate share classes, so that the taxation can't be mixed. Both of them have their own unique taxation rates. So this is on that. We will be sharing so you for further details, you can always refer to Birla RM, or you can reach out to us for the detailed presentations so that we can always share. Then few other questions, just let me look at it if I missed it, which I can answer.
We can take those questions off the record, sir. Yeah. We will send you those questions, sir, so that your team can answer.
Sure. The return till date, the fund had just started. The live fund started on 16th April. So where we have raised, where we have done 6% kind of USD performance in for 15 days. This being a recent fund, only first close has happened on 16th April. We have raised close to 7 million USD in the first close. We are hoping that we will garner substantial amount in next few months as the fundraising goes. Then 3% outperformance is post phase, post all expenses, so that that is correct. Then so these are some of the questions which I felt that I can answer. If there are any further question, Arvind, you can always refer to us. Yeah, sure.
Sure, sir. We will send you, sir. So thank you, sir. It was a wonderful presentation on global investments, and we have also learned how Aditya Birla Sunlife AMC helps investor in exploring global investment avenues. So thanks a lot. So thank you all for attending this webinar. Thank you.
Thanks, Arvind. Thanks, everyone.
Thanks, sir. Thanks.
Have a nice
Thank
day.
you, sir.